When it comes to investing, there are many easy mistakes to make and many common traps to fall into. This video will outline 5 of the most common investing mistakes and the things you can do to avoid them. Hi everyone, welcome back to the channel. My name's George and I've been investing for a good few years now, and I've made plenty of mistakes along the way. For example, trying to follow the herd and not having a clear investment plan. In this video, I'll expand on these mistakes and a few others and give some practical tips on how you can avoid falling into these traps. Following the herd is a natural human instinct. It's an evolutionary trait that's hard to avoid, and in many situations, it can be really useful to follow. If you're walking down a busy street and you suddenly see large groups of people running in the opposite direction, it's usually a good idea to do the same. However, when it comes to investing, following the herd is almost never a good idea, as herd investors are much more likely to buy high and sell low, and base their decisions on an emotional rather than a rational basis. For anyone that's seen the film The Big Short, you'll know that a very small group of investors got insanely rich off the back of the 2008 financial crisis, as they refused to follow the herd and could see the lie at the heart of the American economy, which everyone else chose to ignore or explain away as impossible. Now, deliberately going against the herd isn't a good strategy either, as you're still not thinking for yourself. You're just looking at what other people are doing and then doing the opposite. Think again to the guys from The Big Short. Michael Burry didn't choose to short the housing market just because everyone else thought it was a safe bet. He did it because he looked at the underlying data and determined that more and more people were being given mortgages that they couldn't afford, which would inevitably lead to a market crash. In other words, his rationale was in no way based on other people's thoughts or actions. It was simply based on facts and his own reasoning. In my opinion, not having clear investment goals is one of the biggest mistakes an investor can make, as it's very difficult to determine an appropriate investment strategy if you don't have an overall goal in mind. Imagine two wannabe investors. Both are the same age and both have the same amount of money that they want to invest. Now, at this point, it's almost impossible to recommend an appropriate strategy for them, as we don't know what they want, we don't know what their investment goals are. But what if I told you that one investor had the goal of using his investment to buy a house within 2 years, but the other investor had the goal of using their investment to retire in 30 years' time? Now, given these goals, it becomes a lot more obvious on what we should recommend. For the wannabe homeowner, it's probably best that they keep their investment in very safe assets, like bonds or even cash in the bank, due to their very short time horizon. But for the retirement investor, it's much more likely that they should go for much riskier assets, like equities in emerging markets, as they've got a much longer time horizon for these investments to play out. In addition, having clear investment goals will massively reduce the risk that an investor acts emotionally rather than rationally when times are tough. For example, an investor in their 20s or 30s with a plan to retire at age 50 will be much less likely to panic sell after a market crash, as they know that their investments have plenty of time to recover before they plan on using them. Compare this to someone who hasn't thought about their investment goals. This investor is much more likely to panic and act emotionally if they see the portfolio drop drastically in a short space of time. As with any goals, ideally investment goals should be SMART. That is specific, measurable, achievable, realistic and time-based, and regular reviews should be carried out to track progress towards these goals. Many investors will feel a certain type of way about an investment based on their total returns to date. To quote Warren Buffett, if a stock is at 50, the person who bought the stock at 10 will be feeling amazing, but the person who bought the stock at 100 will be feeling terrible. All these feelings, but it has no impact whatsoever. In other words, it doesn't matter how an investment has performed in the past. That time is gone. What's important is the situation at present and what's likely to happen in the future. Imagine two investors in Nvidia stock. The first purchased in March 2021 at $12 per share, and the second purchased in November 2024 at $140 per share. At the time of writing, the first investor is sitting on a pretty amazing 900% return, whereas the second investor is sitting on a pretty grim 14% loss. And the question is, should these two investors treat their holding in Nvidia differently? Now, hopefully you can see that the answer to this question should be definitely no. The only thing that matters today is how the stock will perform into the future. If Nvidia were to rise another 10%, then both investors would experience a 10% increase from today's value. In other words, the share price is indifferent to your starting position, and so shouldn't be factored in when making decisions. To again quote Warren Buffett, you should always act as if you had a blank slate. Not trying to time the market is one of the first rules of thumb that any new investor will learn, and it gets mentioned so often that it's almost a truism at this stage. But for those that maybe haven't heard about it before, timing the market usually refers to the practice of only making investments when the general economic outlook is looking good and there looks to be room for the economy and the stock market to grow into, and selling investments, or at least not making any new investments and holding cash when the general economic outlook is looking pretty gloomy or the stock market is seen to be overvalued in general. So why is trying to time the market seen as such a bad strategy? At face value at least, it seems to be pretty sensible. Well, accurately predicting the movements in the macroeconomy and the stock market in general is essentially impossible over the long term. Yes, you could get lucky with 1 or 2 correct predictions, but the law of averages states that this won't continue over the long run. There are just too many variables which determine the direction of the economy as a whole, And as Warren Buffett says, it's unknowable, so we shouldn't focus on it. Just think about all the crazy events that have happened in the economy over the years, and think about how lucky you'd have to be to predict, let alone time, even half of these major events. So it's this unknowable nature of future economic conditions that is the essence of why time in the market is such a bad strategy. And as Warren Buffett says, we should instead concentrate on what's knowable. In other words, to make a good investment, we need to focus on the fundamentals of the businesses that we're putting money into, rather than focusing on the general economic conditions of the time. To use an analogy, let's say that you've been set the task of sailing around the world. Now, this voyage is going to be dangerous, but you're much better off focusing your time and energy on choosing the best boat for the voyage, as in the one which is the most stable, the most sturdy, and the most reliable, rather than waiting for the best time to leave based on the weather, as the boat that you choose is a knowable thing, whereas the weather or the general conditions are unknowable. Being level-headed and concentrating on facts and reasoning, rather than feelings and emotions, is a key characteristic of any good investor, and is one of the key teachings of almost all famous investors. And it's been a common theme of what we discussed so far. For example, setting investment goals is in part a strategy to reduce the risk that investors will act emotionally, and following the herd is simply a form of emotional thinking. But a lot of the time, putting our emotions to one side when it comes to investing is easier said than done. After all, this is our hard-earned cash which is at stake, and it's only human nature to act based on how we feel in situations when the stakes are high. And this is an area in which I've struggled before. So here are a few practical tips that I like to use to keep my emotions in check when it comes to investing. First of all, try not to make any big investment decisions impulsively. Take some time to mull things over in your head and sleep on your decisions. I like to take a break of at least 48 hours between making an investment decision and actually doing it. And a lot of the time, I'll find that I'll change my mind during this period. Secondly, write down why you've decided to do something. Pretend you're writing an email to someone explaining what your investment decision is and why you've decided to make it. If you can't explain your decision clearly using facts and reasoning, then chances are you're not thinking rationally. And I find this is a good way of catching myself in the act when I'm thinking based on emotion. And finally, and most importantly, make sure that you've got a cash emergency fund stashed away in a bank account somewhere, so that if your investments do go pear-shaped, you wouldn't have to worry about how to pay your day-to-day expenses. Now, most professionals will recommend that everyone should have 3 to 6 months worth of their expenses saved up in cash before they make any investments. And this is to prevent the need to sell investments early in order to make day-to-day payments, and to reduce the risk of emotional rather than rational thinking when it comes to these investments. Now, if you've made it this far, you might find some of our other videos on the channel interesting, like the one on screen now, which is where we discuss the legitimacy of Trading 212, a popular investment platform. And if you've got any questions for me based on this video, please leave me a comment below, and consider subscribing if you've enjoyed the video. Thanks for watching.